What's up everyone, it's Scotty with Money Vesting. So welcome on board for another market open live stream. We do have the NASDAQ down close to just over 1% right now. So QQQ ETF trading down a little bit over 1%, as low as $280. SPY on the day right now, pre-market also down 1%, trading as low as 376. And we've got the Dow Jones trading down also almost 1%. So all three indices with an implied open of a negative 1% so far. It is the end of the month, end of the quarter. And yeah, we got the PCE numbers. Month over month, core PCE was up about 0.3%. And the headline number year over year was up 6.3%. I'll pull that up here in just a minute. But let's just start our poll. I do have a couple videos that I do want to play. They were released by CNBC, interviews by one of the analysts and CIOs about 30 minutes ago. So that was really interesting to watch as well, because she basically reiterated word for word what we've been talking about, and one thing that I've been super concerned about over the last several weeks as we have headed into the second quarter earnings here. So this right here is going to be the PCE numbers, which we are going to break down as soon as this thing loads. And jobless claims actually came in at 221,000. So that was the number. A little bit shy of expectations, which is a good thing, obviously. So we don't want jobless claims to go up because that's a sign of unemployment. So let's take a look here. All right. Already, Wi-Fi is giving me some issues here. All right, there we go. This is so crazy. What is going on? Yeah, so we got a 0.3 basis point. It's just so frustrating. What? Why isn't this thing loading? Let me try it on a different browser maybe. It's opening up till here, and when I hit view calendar, see, this is the frustrating part. I really want to throw my computer out of this window. All right, so report. Oh my God. This really tests my patience. My internet, my power, my connection really tests my patience every day. So Google Chrome's not working either. Oh, there we go. All right, finally. Okay, so we got the personal income month over month up 0.5%. So 0.5% there. Personal consumption expenditure, so PCE, that's the number that the Fed looks at. That's their preferred measure of inflation. Was up 0.2% month over month, and PCE price index month over month up 0.6%, and year over year, which is the headline for the Fed, PCE year over year 6.3%, and core was 4.7%, and core was up month over month at 0.3%. So again, a little bit shy of expectations. So we were expected to go up 0.4% month over month. We came in at 0.3. Year over year, we were expected at 4.8. We came in at 4.7. Headline was expected at 6.5. We were at 6.3. So a little bit of slight improvement in the PCE numbers, personal consumption expenditure, and personal income also up 0.5%. But obviously, on a year over year basis, it is still nowhere near close to where inflation numbers are. So real earnings are still negative, unfortunately, for 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 the consumers in the U.S. So those are your PCE numbers and income numbers. And then jobless claims, as I said, came in at 221,000. And then that's all for this week. We got the Fed's balance sheet at 4:30 p.m. Eastern. And then tomorrow we got ISM manufacturing numbers, construction spending, all that stuff. But this is going to take forever to load. But it was at 221,000 jobless claims. So that's where we were. We were getting a little bit of a pop pre-market. We were obviously down closer to 2% at one point, but we're seeing a bit of a move higher, so 75 basis point move on the upside for the QQQ ETF. And then the actual SPY numbers, SPY is up a little bit over 40 basis points, 43 basis points, pushing up. And then the Dow Jones here is still down about 1%, but from pre-market levels, we are up a little bit over 31 basis points. The yields, the 10-year yields have definitely been selling off a little bit as the prices are going up. So TLT is definitely pushing higher, so on its way a little bit higher. So pre-market, we are up over 87 basis points for this. So it's up to $114.86. And the 10-year yield is coming down to just a little bit over 3% as energy also starts to pull back. We had a pretty significant sell-off in energy stocks. And of course, we've got a lot of Bitcoin and Ethereum, a lot of crypto-related assets here selling off even further. So crypto is now back under 20,000 again, down about 4%. And Ethereum here down almost 6%. Right now, so trading at just over $1,000. So there's a lot of interesting and juicy data that I want to go over with you guys. The first thing we're gonna do is I'm gonna play this video, which actually came out about 40 minutes ago. So basically, it's a 4-minute video. And New Edge Wealth CIO talks about one of the risks of the market's obviously not revising down, and that's something that we have also talked about. So word for word, she kind of reiterates, and we'll listen in and what she has to say. So I'll just play this. Let me know if you guys can hear this, and I want to make sure the audio is also good. So just give me a thumbs up if the audio is good.
New results from the Delivering Alpha quarterly stock report. 55% of investors surveyed said the Fed was right to get more aggressive. 21% said the current path is more likely to hurt stocks than help the economy. Joining us now to talk about the Fed's path and how to prepare your portfolio for Q3, Cameron Dawson, Chief Investment Officer at New Edge Wealth. Cameron, great to have you with us. Good morning.
Morning.
Powell's basically said that it is the most important thing to get back price stability, and that a recession could be a byproduct effectively. And I'm wondering, how do you invest knowing that is the ultimate objective, price stability or reining in inflation?
Yeah, I think we have to invest knowing that we're stuck in this downtrend in this world of higher volatility. Because as long as the Fed is fighting inflation, as long as they're removing liquidity from the system to fight inflation, it means that each of these relief rallies that we have likely fails at resistance and we roll over. So all these hope trades that we've seen the bottom and that the worst is over, or at least we're moving into a new bull market, likely are way premature, given the fact that the Fed is saying, and actually all central banks at the ECB forum yesterday, they're saying that they're willing to tolerate lower growth. They're willing to tolerate unemployment. They're willing to tolerate a recession, all to keep those inflation expectations in check, which just means equity markets will continue to be volatile.
How do you think about the valuation of the market, Cameron? I mean, I'm thinking about the warning that we got from Restoration Hardware, RH, last night, and they issued this warning where they take down second half of the year, full year forecast, basically, because of rising rates. And they do this just 28 days after posting their own earnings and giving guidance. And this is not the only company that's revised so quickly their forecast due to quickly deteriorating conditions. How are we to even believe the guidance that is given what what Target is saying, a Microsoft, Snap? These are all companies that came out after posting earnings, just within 30 days, revising lower their forecasts.
Well, clearly the environment is changing rather rapidly, and we're seeing this tightness come through where in aggregate, S&P numbers for earnings estimates have not come down. They're still at 10.5% growth for this year and 9.5% for 23 and 24. So as we start to see this weaker data come through, we think estimates have to get cut, not just from the guidance, but analysts need to cut estimates as well. So the end result is that when we look at valuations, yes, they've come down from 22 times to start this year to 16.5 times, but that's just about average. Usually in tightening cycles, as well as in recessions, you see valuations go well below average. And so we think that we have downward pressure on equities from the earnings front and the multiple front from here, which is why we don't think that we've seen the low yet.
So tell me if that wasn't word for word, literally. And this was actually came out today. I was so excited to actually watch that interview because that's the next big risk. I think we need to be prepared for that. That's something that we have talked about. This is an Excel spreadsheet that I've shared with everybody on our Discord. So if you want to get access to it, you feel free to, obviously, go over to that link and see that for yourself. But what she's really saying is that right now, analyst estimates have not come down. They've not been revised down. We're still expected to see $230 in earnings per share. That's at least what the consensus is. And that's going to point to about a 10.3%, almost 10.5% growth in earnings in 2022. And obviously for 2023, we're still expected to see above 9% growth and EPS sitting at $251. So unfortunately, as those data comes in, as the second quarter earnings come in this month and next month in July, we're going to see a lot of companies report earnings. And unfortunately, the problem is, or the biggest challenge is, that these companies have been revising their guidance down, right? Microsoft came on just a few weeks ago and said that they're going to be guiding down their earnings per share revenue estimate. Even though it was a very small number, they still guided it down. And then there's a lot of companies, right, that they're going to be guiding down their EPS estimates. So what happens? Analysts have to cut down their EPS estimates. And the thing about this concept is that you can have an expensive market in a falling market. You can have a market which, even though it's down 20%, still can be expensive if earnings per share comes down, which is in the denominator of a PE multiple. So that's the big downside pressure and the big downside risk, unfortunately, for the markets right now. I think that's the big sort of uncertainty, the big question mark, and that could be the next big leg down if we see one in the S&P 500, which is an earnings risk and a multiple compression risk from the S&P 500 standpoint. So, that's something to keep in mind. Again, this is available for all of our members. You can change. I can actually change these numbers. So right now we're at 3,800, I think so. 3,800 is over here. We can change these PE multiples and the S&P 500 targets, and obviously look at the actual EPS numbers as well for this year, for next year on a forward basis, all those things, and get a good sense of how the S&P 500 is valued, right? Where is it valued? Is it overvalued, undervalued? And also shows us the average. So I've got the averages over here. So a 32-year average on the S&P 500 is traded around 19.5. 25-year average has been 20.24. The 15-year average has been just under 19, and the 10-year average has been 19.7. So right now we're trading at 16.5, closer to 16 on a forward basis, depending on where the EPS ends up being. And we are below our 10-year and our 5-year and our 20-year, 15-year average at the moment, because that 2022 PE is 16.96. This is actually a little bit lower, so this should be this number over here. And our 2022 forward EPS is going to be this number right here. So we're just trading at under 16. So we're definitely a little bit cheaper than historical multiples. But again, if those earnings per share get revised down, then say goodbye to those multiples. And that opens doors for some new potential downside risk. So, that's where we are with the earnings per share. And I also want to go over some very interesting data from FactSet. This is something that we have broken down. Again, this is the spreadsheet that's available if you want to get access to it. It's a Google spreadsheet. But this is the second quarter 2022 EPS estimates. And this is the quarter that's going to get started reporting very, very soon. We had Walgreens report numbers today. And Walgreens, I think, is Slightly down pre-market. I think it's down. Yep. So it's down over 2.4%, even though they beat estimates on both revenue and earnings. The stock is down over 2.4%. So their EPS came in at 96 cents per share, a little obviously down from $1.51 same time last year. And analysts were expecting 93 cents. We got a nice beat, and sales were down to 32.6 billion, down from 34 billion. And analysts were expecting 32.2. So we got a revenue beat, we got an EPS beat, and they reiterated guidance for this year, revenue and earnings per share as well. So for the full fiscal year 22, the health and beauty retail company said it continues to expect adjusted EPS to grow in the low single digits, and revenue also was guided, reaffirmed from the company. So I would say that's a good report. In this market environment, that's a good report, but obviously have to dissect a little bit further. And Walgreens profit beat on the UK pharmacy sales boost as well. So you got a nice beat on EPS and revenue, but yet the stock price is down a little bit over 2.4%. So looking at the second quarter 2022 expectations, but let me just start the poll here, and so that we can get that started. And very interested to see where everybody's expectations are for today. So green, red, and flat, and we'll ask the community. Yesterday was kind of like one of those days where the flat people who polled and voted for flat expectations for the market were actually right, because the NASDAQ didn't really go all that much. It was more or less flat on the day, and so was the S&P 500. So usually we have people vote for either green or red, but there was always a small percentage of people voting for the markets to be flat, and that's exactly what happened yesterday, as we were just more or less back and forth. Ranjit, welcome on board. Everybody, thank you so much for joining. I really appreciate it. So make sure that you do drop a like, so we can get this stream pushed out to more and more people. And let's see here. Chris says deadlifts are good for you, mate. I'm just gonna get started with them very soon. I'm just taking a whole week doing a little bit of recovery, and then we'll get started with those very, very soon. But anyway, energy here. So second quarter 2022 growth, energy is still at the top of the list at over 215% growth expected to be posted by some of these companies, which is, comes at no surprise because of the higher gas prices and very, very nice profitability from these energy companies, followed by industrial, material, real estate, and then S&P 500 is expected to post 4.3% in earnings growth for the second quarter. And then there are information technology, 1.3%, healthcare, 1%, consumer staples actually down negative, 2.6%, and communication services, right? Communication services down 8.6% negative. On March 31st, you can see that it's been revised down a little bit. So for March 31st, at the end of the first quarter, communication services was expected to pretty much be break even for the second quarter, but now it's been revised down to 8.6%. Consumer discretionary, negative 9.3%, been revised down significantly from 13.5%. And then utilities and financials been more or less the same. If anything, they've just been revised down a little bit more in terms of earnings growth for this upcoming quarter. And then let's just take a look at, revenue. So I'm just going to go over to the revenue now. This right here is a revenue number. Energy is still expected to post very strong numbers at 44.5%, followed by materials, real estate, industrial, consumer discretionary, all of them positive. And then S&P 500 at 10.2% revenue growth for the second quarter. IT, healthcare, communication services, staples, all of them, low single digits, mid single digits. These are the expectations for the upcoming quarter, which all these companies will report on. This is the number of S&P 500 companies with positive and negative guidance. So in the healthcare, we've got the most negative guidance in healthcare, followed by industrials and then utilities, and then consumer discretionary. This is for 2022, 2023 EPS guidance. And then information technology, we've got the most number of companies with positive guidance for the future. And there's a couple different charts that I want to show that's really, really important in terms of the growth here. So this is for the full calendar year 2022. Earnings for energy are expected to exit at 120%, So again, this is going to be a very, very strong year for energy. They're expected to close out the year with 120% gain in earnings. At least that's what the consensus is. And for technology, only 11.7%. S&P 500 still pegged at 10.4%. So remember what we looked at our Google spreadsheet. It was 10.3, 10.4% at $230 EPS. That's the EPS expectations, at least for now, as of today, as of whenever this report was on June 28th. So that's the interview we just heard, and that's one of the concerns that I have, that it still hasn't been revised down. If it's not revised down, then unfortunately the P multiples is still going to look very, very attractive, even at these prices. And of course, we got some of the other sectors still more or less up slightly now. Now, the interesting thing is that even though energy is expected to be up a lot, 120% in earnings growth for this year, look what happens starting next year. So 2023, right? This is for next year's earnings for the full fiscal year 2023. And you'll notice that energy is the one that's expected to be down the most at negative 11.8%. Can anybody tell me why that is? Can anybody tell me why energy is the one that's expected to be down substantially next year in earnings growth versus this year, where we're seeing 120% growth? Can anybody answer that question? Come on, I need some more engagement. I feel like I'm just talking and nobody's participating. So Oscar says oil will come down. Well, that's one reason, but there's a bigger reason. Nobody knows where oil's going to be. Lower demand for energy. So LOL is very close because it's so there we go. Nishant got it. They compare year over year. Nishant got it. So that's the right answer. It's comps, right? Comparables. And that's what really matters. And yes, other answers are also right. Energy expectations, the demand and oil prices are also expected to come down. But the real big reason is comps. And that's exactly why you're having technology and communication services go through such a bad year this year. You know why? Because we're comparing them to last year's very, very strong numbers. So comps are really bad. And next year, energy is going to go through this similar process of comps being really, really poor because they're going to be comparing with these super high earnings per share and revenue numbers. And if for any reason oil also starts to come down, then comps are going to be really, really brutal to compete with for these energy companies. That's why the expectations are really, really low. So that's why, I talked about it, in Q4 22 or first quarter 23 is the optimal time to really consider if you are somebody who's interested in shorting oil or taking a short position on some of the energy companies. That would be a, trade plan that we can sort of come up with and decide what's the best strategy to go about it, because earnings expectations are certainly pegged downward for the energy sector right now. So this is where we are. $251 is going to be for 2023 and $230 for 2022. So these are the two EPS estimates for this year and next year, and that is still pegged at pretty high numbers, right? Even though the companies are guiding down. So these numbers, in my opinion, at least, analysts are going to see that. And if we do enter a recession, then obviously it's not going to be super great for the next couple of years worth of earnings per share. We have seen a little bit of decline. It's not like the S&P 500 has been charging through with these earnings per share. I mean, you'll notice that for majority of 2012 to 2016, the earnings per share didn't really move all that much. It went from $105 to $119, right? So what is that growth in a 5-year period? So 119 divided by 105, we grew by 13% in 5 years. In 5 years, earnings per share grew by 13%. And let's take a look at how S&P 500 performed during that time. And we're looking at 2012 till 2016. So 2012 to 2016, the S&P 500 was all the way over here. So right here, 2012 is right here. So this is 2012. We were at 1,269 till 2016. The markets went up over 71%, right? So even though earnings were more or less flat and they were up only 13%, the markets went up over 71% during that time period. What does that do? What can anybody explain to me? What does that do for the P multiples, the price to earnings multiple? If earnings are more or less flat, but obviously we've got the S&P 500 going up 71%. So what's happening in that time period? Hopefully there's no lag. I feel a couple people are talking about lags. Okay, better now, Oscar says. Okay. Yeah, so Oscar and LOL, Haxen1 says it right, multiples to the moon, right? So multiple expansion. And that's what happened during that time. Multiples expanded significantly during that time, even though earnings per share were flat. EPS only grew 13%. Yeah, so P will increase, very good. And S&P 500 went up 71%. So Joseph says B compression. No, in this case, P expanded. So it actually went up because earnings per share, which is the denominator, pretty much stayed flat. And the price, which is in the numerator, actually went up. So P multiples expanded during that time. So these are the expectations, and right now we're kind of working against that force, that even though EPS prices coming down, if EPS gets cut down, we will see multiples go up, which can lead to more compression in the future, given the macro environment that we're in with all the recession fears and higher interest rates. So that was the entire, quick presentation that I wanted to go over. I know it can be boring, but trust me, this is important stuff. We need to kind of have a good idea, understanding on, what the EPS estimates are, what the forecast is, what P multiples the S&P is trading at, what is potential downside, and of course, all the other things that we went over in this presentation. So I know it can be a little bit boring, so I do apologize, but let's just go back to our individual stocks, and anything that you want me to go over, happy to go over that for you guys as well. So 61% expecting the markets to be red today. So not a surprise. We are, down. Pre-market down a little bit over 1.3%. So 62% expecting the markets to be down, 30% green, and only 9% expecting the markets to finish flat. So, question, what is usually expected on the last day of quarter? More buying or selling pressure? It really, there's no definitive answer. Like there's no factual data that I can point to that, okay, last day of the quarter, there's always been more buying or selling. One thing there's always been is there's been more volatility. So there's been more rebalancing taking place. But that rebalancing could mean anything, right? Rebalancing could be sell-off in stocks and increase in bonds, which is what we are seeing right now. We're seeing a little bit of a pullback in the QQQs. So stocks are selling off, and the TLT ETF, which is the bond prices, they're pushing higher on the day. They're actually up over 82 basis points as yields are coming down. So we're seeing a little bit of rebalancing from equities over to bonds today, but that is not necessarily the case every single time in the last quarter. There is rebalancing happening. The rebalances happen towards the last week of the quarter, last couple of weeks of the quarter, but there's definitely no factual data that suggests that there's always been buying or selling pressure on the last day of the quarter. So Reina, thank you so much. If you have any questions, I'm happy to help. So definitely reach out to me on Discord and I'll get back to you as soon as possible. In fact, within 24 hours, I'll get back to you if you have any questions. And thank you so much for joining. I really appreciate that very much. So QQQ Bull, thank you so much. And yes, make sure that you do drop a like, everybody. I really appreciate that. Where do you find the jobless claims, Brandon? So you can find them anywhere. You can go to the BLS website, or you can actually find them on Econ Day. That's where I look at all the data for economic reports. And I think the numbers were 221 or 231,000, around those levels, but they still came in shy of expectations by 2,000, which is a good thing. In fact, speaking of jobless claims, in the Bank of America Global Survey, where they had over 4,000 professional money managers, fund managers take that survey, they listed jobless claims as the second big reason as to why the Fed could pivot. The first one was PCE under 4%, which is the inflation number under 4%. We don't have that yet. Jobless claims at over 300,000. Right now we're at 231,000. I think that was the number. And the third reason was the S&P 500 at 3,500. We obviously don't have that either because the S&P 500 right now is at 3,800 at the moment. So those were the three reasons listed by global money managers, professional money managers, and fund managers as the reasons as to why the Fed could potentially pivot in the future. But right now we're still at 200,000 roughly for the jobless claims. Now that number, in my view, I wouldn't be surprised if it does start to go up a little bit because of all the layoffs and the hiring freezes that we're seeing from all these companies. So, if it does get up to 250, 260, 275, then it's going to be a little bit concerning from an unemployment data standpoint. By the way, unemployment comes out next Friday, not this Friday, but next Friday, July 8th is when the unemployment numbers come out. So yeah, that's where we are, and these right there were the jobless numbers. So 231,000, not 221, but 231 were the jobless numbers. Came in much better, so 2,000 shy of expectations, and the prior number was 229,000. So you're already seeing week over week slight increase in the jobless claims. So that's a little bit telling, but definitely we need to see trends of consistent increases in the jobless claims numbers. Help to choose Zoom versus Etsy. So yes, looking forward to your review on ARK's analysis on Tesla. I looked at their Tesla's valuation Excel spreadsheet. I don't think they've made much changes to that. I've actually done a video already on their Tesla's valuation. I think their price target's well over $3,000. But yeah, Zoom was crazy. For everybody who did watch the video, what do you guys think? What does everybody think about their Zoom's valuation that they have? Zoom's prediction pretty much that they made. So for those of you who didn't get a chance to watch the video, I would highly encourage, if you are interested in Zoom or want to get a good understanding on her valuation model and where she sees Zoom price going in the future. But just as a quick summary, right now Zoom globally has about 212 million users. And of those, there's only 36 million users that are paying for Zoom, right? So out of 212 million users that are using Zoom, 36 million are paying. So that's a 17% conversion that Zoom has. Now, ARK believes that over the next 5 years, by 2027, their users are going to grow from 212 million to 290 plus million users, which is not a lot. Like, that's very much possible, right? It's going to go from 212 to 290. That's about what was that growth rate that we calculated? So 290 divided by 212. That's about a 36% growth over the next 5 years, which is very much doable. But what they really mentioned in that report was that their conversion rate, which is how many users actually start paying for the service, is going to go from like 17% all the way to 50%. So out of those 290 million users, about 145 million are going to be paying users for Zoom as they launch new products, whether it's Zoom Rooms, Zoom Conference, Zoom Events, whatever the case may be. They're going to be paying members. And not only that, the average revenue per user is also going to grow from about $112, $115. That's where it's now. $113, I think, is the average revenue per user today for Zoom. And that's good. That number is going to go from $112 to $356 per user on average. So when you take those two numbers, 145 million paying users and $356 per user, you get a revenue of over $51 billion by 2027. And then she's just working backwards. She's just applying a 45% EBITDA margin, a multiple to get the enterprise value, to figure out the market cap with the share count and the dilution to get a price target of $1,483 on the stock. So I think the only concern that I have is that there's a lot of assumptions being made on the actual target, which are way too high. Like, she's not conservative on any part of her analysis. Even the bear case, even the base case points to over $600 target on Zoom, which from these levels, is about 500% increase over the next 5 years. So yeah, it's, that's very, very bold. Definitely very much on the high end, but we'll see if it actually happens. I mean, people called her crazy for Tesla 5 years ago, right? 3 years ago. But Zoom is a little bit different, obviously. I mean, there's a lot of competition already. And if Zoom is even relevant in a post-pandemic world, that's the big question. You personally believe more Zoom than Etsy? I actually think that Etsy is better valued than Zoom. But Zoom's got a great balance sheet too. I mean, they've got plenty of cash, so there's no bankruptcy risk. But it's hard to really understand if the Zoom's relevance will still be there 2 years from now, 5 years from now. That's the big question. And it's not even a fundamental question. It's not even like a numbers question. It's not even about looking at the balance sheet or cash flow. It's just a simple logical question. And I want you guys to answer too. Do you think Zoom is still going to be relevant 5 years from now? Are people still going to be using Zoom? That's a simple question. And I don't know. I honestly don't know. I think people have mixed views. Their companies have used Google Hangouts. They've used Microsoft Teams. Zoom is also a big part of that video conferencing world, but it's hard for me to really see the relevance of Zoom over a 5-year period where companies and individuals are just going to keep using their platform. And in fact, they're going to be paying more money to use their platform. Anyway, let's just take a look at some of the comments here. Oscar says 100% on that Zoom video was insane. Okay, so let's see. Yeah, so I think other things will provide competition. I think if there's so we've got what is it? Which airlines? I forgot what it was. I posted it in our Discord, but there's Spirit Airlines are just consistently being targeted for a buyout from let me check. JetBlue, right? So JetBlue's just been targeting Spirit Airlines. Pretty much they've been sending these offers like it's nothing. Every day there's a new offer on the board for Spirit Airlines. And you know, JetBlue obviously really wants to buy this company, but they've had this rejection like 5 times already. So airlines have obviously been under tremendous pressure. A lot of cruise lines, airlines, they were all down. They have been down a lot. You know, Carnival was down substantially yesterday, down over 14%. So definitely been selling off pretty aggressively here. They've got a lot of debt. I think that's one of the problems with a lot of these cruise lines and even airlines to some extent is the debt is pretty substantial at $28 billion. You know, cash is sitting at 9.5. So they obviously don't have enough cash to pay down their debt. So these are, you know, definitely very indebted companies at the moment, especially some of the cruise lines. Okay, so if you have any questions about any, so yes, Kat, we need a broker list for Poland. A lot of people Poland on your Discord. So send me a message on which Discord, which broker that you use, and I'll add that to the list. By the way, for everybody who's in our Discord, we've created a broker list for everybody to access. So you can actually go over to our Discord, and this is the channel called Broker List. And we have actually broken this down by country. So this is super helpful for anybody who's just joining in or wants to get some good recommendations on what brokers to use. Again, these are not endorsements by any way. These are simply brokers that our members use. So, you know, if you are in the US, which brokers you use, we've made a whole list. And you can check them out in the UK, India, Australia, Canada, Singapore, like all these different countries. And you can, you know, definitely do your research on them to see if it works well with your strategies. So we'll continue to add more countries and more brokers that people use. Again, these are from our members, and they're the ones that are using them and have experience with them. So I obviously have mentioned that I've used TD Ameritrade, I've used Webull, I've used Robinhood, I've used Fidelity, I've used a couple other different brokers in India. So obviously, if you're in India, I can definitely help you with those. But other parts of the world, we've got plenty of members that are using different brokers from all over the world. So, okay. Thoughts on Celsius. I haven't really done a video on Celsius. I don't know if, let's see. So Celsius as in, what is like the Celsius the company or Celsius the token? Which one are you asking, Alonzo? Alex says red. Look at futures. They are in deep red, and I need to load. Yes, they have been selling off quite a bit. And Javier says, I think we'll see a rally at the open when shorts will take over. So yeah, I think that's very true. I think I did a video on Upstart earlier, and short interest on Upstart has definitely gone up quite a bit, right? It's up to 38%, 38%. And if you take a look at some of the highly shorted stocks, Upstart is now in the top 7 stocks there. Okay, CELH, the company. All right, let me take a look. And then we'll take a look at some of the highly shorted stocks here. Okay, so Celsius Holdings, they've got earnings coming up in August. Right now, the market cap is at about 4.8 billion. The volume's been a little bit thin, not even 1 million shares, but strong, consistent growth in revenue, strong quarterly growth as well. Very nice to see. And let's take a look at the earnings here. So wow, 502 times earnings is where it's trading at the moment. And then we've got 12.5 times sales and 736 times EV over EBITDA. So gross margin at 40%, very, very low net margins for the company, 5% only. Return on assets, equity, and invested capital is also really low. We look for these in the mid-teens to high teens. Current ratio is good, 2.67, so they seem to have a decent hold on their liquidity and their short-term liabilities. Let's take a look at their overall cash versus debt. So that's great. They're sitting on well over $16 million in cash with very little debt as of the most recent quarter, only 1.45 million. But they've also been increasing their share count a little bit, right? So annually, they've gone from 68 million to 72 to 74. It's actually not that much. So definitely not a lot of share dilution. But the valuation seems to be really high because of lower margins for the company. So the one thing they need to do better is they need to be more efficient with the way they utilize their assets and invested capital in order to become more profitable. The revenue growth has been good, but they just need to figure out how to be more profitable and get those margins above 5%. I mean, that's been the trend, 1%, 6%, 2%, 5%. Annually, they were at 13% and back in 2019. They were at 6.5%, then they dropped down, and then they came down 1.25%. So margin expansion is really important for Celsius so that they can bring those P multiples down. Right now, it still trades at pretty high multiples in my view. So, okay, so we were looking at some of the high short interest for some of the stocks. So let me see if I can bring that up. Okay. 1 second. I send that link to. Okay, so it's highshortinterest.com. There we go. So these are all the companies that definitely have, pretty significant short interest right now. So you can see that Beyond Meat is at over 40% short interest. We got Revlon. I think this was one of the companies that filed for bankruptcy. I haven't been keeping up with this one, but they've also got 38% in short interest. How are they actually doing right now? I could be wrong, but I did read about them that they were filing for. Wow, they've been so volatile. They dropped 52%, then another 42%. So they were down over 77% only to go up. Wow, 757%. That's some serious amount of volatility for this company. This might have been all due to the shorts covering here after the 76% drop in the stock. So, wow, 780% jump. That's insane. We've also got Nikola. Not a surprise there. But then Upstart right here, number 7, 34, almost 35%. That was a big price cut from Morgan Stanley, right? 78% price cut. And in my view, I think if you're cutting the price by 78%, there was something seriously flawed in your assumptions that you were making earlier. I mean, there can be a small earnings revision to the downside, or maybe a P multiple. You're basically using a conservative P multiple, but a 78% cut is too much. It's just really, really too much. So yeah, so Upstart is there. Then we got Vertex Energy, Bed Bath & Beyond still up there, 31%, 32% short interest. Wayfair is another one, 30%, pretty known brand. Ocugen is up to 28%. Carvana. So this is also a stock that's been sold off after the pandemic pretty substantially. Right now, 28%. Workhorse has been up there. Fubo TV. We got Skills. AMC and GME. I'm not sure what the short interest is for those, but they're not on this list. At least not in the top 10 or top 15. But anyway, let's just circle back to the markets. We got the NASDAQ still down about 1.1% right now. The S&P 500 is, still down about 1%. Pre-market, we're going to switch over to the indices now. S&P 500 over here, NASDAQ, and we got the Dow Jones over here. Oscar, in general, it's a very bad thing if things are shorted. Well, not necessarily bad, but it just leads to potential short squeezes that can lead to very violent moves to the upside. So that's what we saw last week as well. A lot of shorts covering their position. Just showed you guys the example of Revlon and how much it went up. And this is, after the 76% drop, you can see that shorts were more likely covering. Let me see how the volume was. So volume, yeah. So look at the volume here in these moves, right? These are very much 186 million shares traded, 177 million shares traded, 146 million shares traded. And on the way down, the volume was so low, 4 million, 5 million. So this was such low volume sell-off and then such a high volume covering taking place. So, shorting definitely does leaves more room for short squeezes, and that was obviously the whole, the reasoning behind AMC and GME kind of going parabolic and going up thousands of percents. So, anyway, if any questions you guys have, I'm happy to go over those and break down any companies. We've already gone over the second quarter earnings expectations. Very, very important. Keep a close eye on the multiples on the S&P 500. Access to your Google spreadsheet is available for you, so you can check that out as well. This is, again, you can go to that spreadsheet over here, see that for yourself, what multiples we're trading at, what is the EPS consensus estimates, and the historical trends. This actually goes back as far as 1988. I'll try to find earnings even before that, see if I can go back even further. But this spreadsheet will go back as far as at least 1989 to help you understand where the S&P 500 was and where the earnings per share was right now. And this goes out far to 2023, and then I'll add 2024 as well. So that's available. Yes, so Lindsay, I did see the Grizzly shorting Neo with a JPM reaction. I've still yet to catch up on that. Those both reports I received from Oscar, by the way, but I will read them. I haven't had a chance to read them. Just been, extremely occupied with other tasks, but I will definitely get back to that. Elric asks a great question. So why would you know why TLT is on the rise now, inverse of the S&P 500? What changed? Trying to figure out when it will stop or turn back. So, the first thing is that TLT is not an inverse of the S&P 500, right? So it's just a bond ETF. So it's not an inverse, right? Just because the S&P 500 goes up or down doesn't mean TLT is going to go up or down. In fact, they've been more positively correlated in 2022. So they've both been moving in the same direction as the yields have been going higher. So I think TLT going up today might have something to do with the fact that yields have gotten really attractive, and there might be a little bit more demand towards the bond market. And as bond prices go up, yields come down. And today is also last day of the quarter, so that might also mean a little bit of rebalancing taking place for fund managers and pension funds and all those big money managers as well. So they could be plowing some money into TLT today as yields are coming down, and money's kind of taken out from equities over and going over to the bonds as well. So that could be the reason. So Anthony, are you making short-term trades more often or less often in this market, and have you found more success in short-term trades? Yes, absolutely. I think, as I've said before, This is a very choppy market environment. So instead of being a victim to just this bear market and buying and the stock markets just selling off even further, we need to adapt to like a changing market environment. I think it's best. This is literally the best time to learn new strategies. And if you can, learn and test out different ways to hedge your positions and understand market direction, risk management, plan out your trades, this is the best time to actually do it. And overall, I've personally been trading options and a little bit of short term more often than dollar cost averaging or buying for the long term. Still doing that. Still picked up more shares for AMD yesterday. Still picked up shares for Walgreens last week. So still dollar cost averaging in smaller quantities. But our main focus has obviously been on options, on hedging, and taking swing trades on whether it's some leverage ETFs or TQQQs. The trade that we took not this week but last week, and then focusing on that more. And as I said in our Discord as well, we'll have plenty of times to dollar cost average for the long term. The markets are not going anywhere anytime soon. We've got plenty of stocks down 20, 30, 40, 50%. So it's not like, we're going to go back to all-time highs next month or tomorrow. So we'll have plenty of time to dollar cost average. So I think this is the perfect setup to dive yourself into newer items, newer strategies. I just want to see all of us be better equipped for all market environments. And that's what I want to accomplish with this, is whatever the market throws at you, you have a strategy in place, right? So you're prepared for whatever happens. And that's the mentality that I want to get us into, and not just be a victim to the market selling off and just buy, sell off, buy, the markets are down, buy, and it keeps dropping, right? That's kind of, it's consistent, but it's not doing us any favors and it's not showing any results either. So, okay, so where are we? We got about 4 minutes left for the markets to open here. So, Caddy, are you selling cash to puts on AMD? The price is ridiculous. I'm tempted to sell some. Yes, so I will be looking at it. I did pick up more shares though, but cash to good puts absolutely look very, very attractive at these levels. Obviously, it's come down over 50%. So, January, I think I'll do like another video over the weekend going over cash to good puts and the returns. And last time we checked AMD at, I believe it was over 10%, 12% return on cash. Over the next 6 months, I'll do an updated analysis and see what that new return is going to look like for this stock. And I'm sure it'll be like north of 15% or something. So, Oscar, it's demotivating to keep buying the dip at month over month. Yeah, that's true. And, that's why we need to kind of pivot and adapt well in this changing market environment. And, best time to learn options. I think once you learn the right strategies, it'll be a no-brainer. Like every person that I've actually spoken to about options and I've actually taught them, have always wondered, why have I not started this earlier? Why didn't I start this sooner? Because that's what it's all about, right? It's not gambling. Definitely, you can minimize your downside risk, and you can do them in a very, very safe and consistent way. So, Aaron, welcome on board. Thank you so much for joining. Really appreciate that. Okay, so let's see any companies. So what do you think about travel stocks like CCL and Norwegian? So Wilson, I do think that they're very much in debt, unfortunately. I think that's a big, I don't know why my keyboard is just typing numbers. It's happened so many times today. I don't know if you guys have noticed, but I'm typing actual letters and it keeps on bringing up numbers. I don't know what's going on. It's just so weird. But anyway, CCL was down over 14% yesterday. Brutal day. I think it got downgraded as well. One of the banks downgraded this stock pretty substantially. But unfortunately, their balance sheet's not that great. Yes, they can do well in a post-pandemic world. The demand can come back in, but they do certainly have that bankruptcy risk, given how high the debt numbers are relative to the assets and the cash on the balance sheet. So, those are some things to not take lightly for Carnival and Norwegian and stuff like that. Cursed keyboard. So, okay. Yeah, Goldman, $7 price target. Yeah, I think they downgraded pretty heavily. Okay, so 30 seconds left for markets to open. We've got the indices open right here. Quick check on individual stocks. We got Nvidia down 1.2%. We got AMD down 30 basis points. PayPal is down 69 basis points. Google here down almost 2%. Wow. Pretty substantial drop on Google, down almost 2%, 2,200. Tesla's down 1.67%. 675 is where we are trading. Amazon 74 basis points down. Meta is down 1%. And Apple is down 1.4%. And there we go. We are open for trading. And so far, pretty red. Of course, all FANG stocks down in the tune of anywhere between 1 to 2%. These are all my FANG MANT stocks. So we got Facebook, Apple, Amazon, Netflix, Google, Microsoft, AMD, Nvidia, and Tesla. And then, of course, we got some individual stocks over here as well. Volatility, 29.5. We're up almost 5%. Sonymous, we already did the poll. The consensus was a red day today. Over 60% of participants voted for a red day, which is not surprising considering that we are down over 1% already for the indices. So, what is it today? Today is the last day of the month, the last day of the quarter. So we have a big task on the NASDAQ. What is it? What is the big task, everybody? This is a 14-year-old trend that we're witnessing together. 14-year-old trend. What is the big task on NASDAQ today? What is the big battle between the bulls and the bears? Hold the line. Yes, so that 50 EMA, that's the one to watch. Sits at 11,095, so we're 60 points away from that level. So yep, so 50 moving average, 11,100, that's the level. Yeah, so if you take a look at this entire NASDAQ chart, perfect validation every single time, coming in since 2010. So once, twice, 3 times, 4. This was during COVID. We sold off, but we then got bought up very quickly. And here we are. So we should do a poll for this. Right? We got 530 people watching. I want at least 500 votes on the NASDAQ. Breaks below 50 EMA. Holds above 50 EMA. All right, so what is it going to be? Let's see. We're already down 1.3%, so it's not looking too good. Trading at 11,020. But yeah, it should be. And then on a weekly chart, we've got the 200 SMA sitting at 10,800. That's also going to be important, but that's going to be important tomorrow, not today, because tomorrow is the weekly candle that's going to close. So we'll worry about this tomorrow for the 200 SMA. And the S&P 500, of course, is not anywhere near close to that 50 EMA. So that's going to be sitting at 3579. So that's going to be the level to watch. We did breach that level during COVID, and of course quickly got bought up. Same thing happened in 2018. Same thing happened in 2015. And then of course a couple validations over here at the 200 simple moving average on the monthly chart. So all eyes on the NASDAQ, and we're down to 11,013. So not looking too good. Yeah, we're taking problems one day at a time. We live to fight another day. But yes, we're taking the problems one day at a time, breaking them down into dailies. Instead of looking at one big problem, which is the market, just take it day by day. You know? So, I think with the earnings risk that we have looming, I think for the second quarter earnings and the big potential for multiple compression that we still have on the table very much, that I think is a big risk and could be the next leg down on the S&P 500. So if analysts start cutting their estimates, if companies start guiding down, then yeah, it's not gonna be so good, because we're still okay. So now we're starting to lag here. I do apologize, guys. Bear with me. John Corvetti says, I'm just curious about what happens when it breaks. Well, you know, it's a big technical breakdown, right? So it's a big technical breakdown, 14-year breakdown, because over the last 14 years, the NASDAQ's managed to close above its 50 EMA on the monthly time frame, and this is the first time that we're seeing a breakdown. So it could be a big technical shift. It could take a long time for us to get back above that level once bears are in full control. So, wow, the consensus is actually pretty break even. We're like this. We got a room full of bulls and bears expecting the markets to, NASDAQ specifically, to hold above its 50 EMA and break below the 50 EMA. 54% expecting the NASDAQ to break below, and 46% expecting for the NASDAQ to hold above. So very, very interesting poll. I thought it was going to be more one-sided, but apparently not. NVIDIA only down 1%. AMD is now in green. Meta is only down 50 basis points. Amazon getting destroyed yet again, down over 2.6%. Tesla on the move, almost break even on the day. And then we got Google down about 1.7. PayPal is down 2.4, hitting a new 52-week low, unfortunately, 69.61. And then we've got Apple here down about 1.5% as well. So NASDAQ still down. Where's the... Oh, there it is. Now it opens for so late. 37.67 is where we are. And the Dow is going to be all the way down here. Toronto's Dave says so much negative is already priced in. So I do agree. I think, you know, when I went over that in another video, what's been priced in. God damn it. There's something wrong with the Wi-Fi now. Oh. Yeah, I know there's a lag. Sorry, you guys. I should just make a t-shirt that says still lagging. Because most of our live streams, the internet absolutely messes up with me. Let me know when it's good, when it's better, so I can start talking again. Elric Malver, it's not. I mean, really, it's not. It's just the internet. It's just... Over says, so lag is because of you, and I turned down to 144p. Oh my god, are you really watching me in that resolution? But the market's obviously selling off even further. The NASDAQ's down over 1.77% now, almost 2% down. The Dow is down over 198, almost 200 points. And we've got the S&P 500 down over 1.51%. So, yeah, we're back in a bear market for the S&P 500. And the NASDAQ obviously breaking down pretty aggressively. The Wi-Fi is just like right outside my room. So it's like right above, right outside my room. So it's actually not that far, but people are saying it's the red mic. Oh, I know. 2022 is the year for the red mic to flourish. It's the year that this mic is gonna do its thing. So Apple, Google, Netflix all down 2%. Amazon's down almost 3% now. NVIDIA, Tesla down over 1.5%. Let's take a look at some of the Dow names, Dow 30 stocks here. Walgreens, wow, 5%. Ooh. Crazy sell-off on good earnings. Earnings beat and revenue beat. Stocks down 5%. Great. Salesforce down 4%. Boeing's down 3.4%. Then we got JP Morgan, Goldman Sachs, Apple, Visa, Disney. So all Dow 30 stocks are down, all of them, except for Pfizer, that's slightly higher. So Pfizer is up over 86 basis points right now. FinTech, we've got all stocks down. Block is down 4%, 5%. Affirm, PayPal, SoFi, MasterCard, Visa, all of them down at least 4, 3, 2%. Insane amount of momentum downside. Let's take a look at retailers. So it's going to be this. All of them down, starting with Walgreens. We got Macy's, Best Buy, Target, BJ's, Lowe's, TJX, Home Depot. Walmart, Kroger, CVS, all down. Energy is also down, with ExxonMobil down over 2%, BP is down 1.3%. So all parts of the market are selling off. It's not like money's rotating away from one place to another like we saw, yesterday or a couple of days ago when energy was green. But cybersecurity down 2 to 3%. So Walgreens EPS year over year is down. So that's true, from 151 down to 96 cents. But on a full year basis, they're still guiding for mid single digits, low single digits growth, and they actually beat estimates as well. But obviously in this type of market environment, you will find stocks sell off even if they do report some good numbers or great numbers. So that's where we are with semis. So chip stocks all down 2 to 3%. So the heat map's pretty red today, I'm assuming. NASDAQ's down over 2% now. S&P is down over 1.7%. And the Dow down over 1.7 as well, almost exactly as the S&P 500. So, yeah, pretty bad markets right now. Could this be the capitulation break we have been waiting for? Well, I think we still haven't broken below the 52-week lows. The S&P 500 52-week lows are at 36.28, so we're still not at those levels, right? So if you take a look at the overall trend, that is still the 52-week low. Same thing with the NASDAQ. We're not at those lows yet. We're still, this is the low. We're just coming right back down. We've actually been lower. 10,500 has been the low on the 52 weeks. So I think the markets do need one big flush, which is going to be the earnings scare. I think the growth fears. Once that's priced in, you've got a market that's pricing in high inflation, high interest rates, recession fears, and earnings slowing down. All the major risks are going to be priced in to some extent. Now, the degree is going to deviate. From then on forward, all we're going to see is a degree deviate. So what I mean by that is, right now I think there's about 25 to 50% probability, right, of a recession. In some cases might be even higher, depending on who you're asking, but a very high likely probability that a recession is very much on the table for either this year or next year. Interest rates, the Fed and the ECB, we heard that from the forum, we've heard that from the FOMC meetings, we've heard that from plenty of places from Jerome Powell and the Fed. They're being aggressive. They're going to be raising rates. So we know that, right? 3.5%, 4%. Is that going to be the number by the end of this year? Probably, right? That's the Fed funds futures. It's already been priced in. That's where the market thinks the interest rates are going. Inflation expectations, that's a big question mark. Are we going to see inflation deflect down? Michael Burry tweeted there's going to be some disinflation because of higher inventory levels. I do think there's going to be some divergence away, right? With total CPI going a little bit higher, with energy and food cost still remaining elevated, and commodities excluding food and energy. So that's the CPI number that the Fed has a little bit better handle on. With interest rates, discretionary spending drops, and that's going to be the core that starts to deflect down. So there could be a divergence in those two things. And then finally, we get to earnings per share. How all of this affects your bottom line, your EPS, is what's really going to matter to the market. I think that's what's not been priced in yet. Once we get that to price in, I think that's what's going to cause the market to see that one big flush that we're waiting for. That could mean the NASDAQ at 10K, S&P at 3,500. It's very much possible, still on the table. You can't rule that out. And then it's all going to matter on the degree, right? Is there recession probabilities higher? Is earnings, expectations revised down enough, or does that need to come down even further, or lower? That's what's going to be, I think, the next driving force. But it only takes obviously a few reports of inflation to expect inflation numbers to come down and show signs of improvement for all of this to go away. Isn't this crazy? Like, inflation numbers come out much better than expectations. They surprise big time, and the markets will absolutely boom. But we're nowhere near close to those times yet. I think it's going to be a while. Okay. So where are we? NASDAQ here, down 2%. S&P is down 1.5%, and the Dow is down 475 points. So much for JP Morgan's 7% rally this week. They've got one day. Today's Thursday, and S&P 500 is down on the week. It's down 4%. So they've got one day. If JP Morgan is actually right about their prediction, S&P 500 is going to be up about 11% tomorrow. 4% to cover up to become break even, and then another 7%, because that was their big prediction. So yeah, I mean, you've got all fintech stocks down. So you got Visa down 2%, MasterCard's over 3%, SoFi 3%. Should add Upstart to this as well. Upstart's down 5%, down to $30. PayPal is down over 4.5%, and then we got Affirm, Square, Block, all of them down, pretty substantially. You've got cybersecurity selling off, all down anywhere between 3 to 4%. You've got banks. It's a bloodbath, absolute bloodbath, just all selling off. And then of course energy. There's no relief in energy either. All of them selling off. Let's just bring up our heat map. Yesterday, during the ECB forum, there was one thing that Jerome Powell definitely said that kind of shocked me and surprised me, and he said that we are only starting to learn about how little we know about inflation. I think he said something very similar to that. I think so. We were watching it obviously live. I don't know how many of you guys picked up on it, but I can't remember the exact statement. But it was something very similar along the lines of, we're only starting to learn how little we know about inflation. And I was like, wait, what? Like, what? What? How can you say that? That's such, that was crazy though. Okay, so this right here is the heat map right now. So obviously it's red across the board. Pfizer, like I said, the Dow 30 stock, that's the only one that's up 1.9%, but obviously energy selling off, Amazon, Tesla, Google, chip stocks, Microsoft, Apple, banks, fintech, all of them down. Healthcare, industrial, utilities, materials, everything just straight up down. Have you done a video on Fortinet? So not specific to Fortinet, but I have done a video on cybersecurity stocks in general, which we also cover Fortinet in that video. So you can definitely watch that if you're interested in my take. HE, do you believe in Caddy? I don't. So I think Jerome Powell is just trying to calm the markets. I think that's all his job right now, is to make sure that people don't freak out. I think that's all he's done, because everything that he talks about obviously has been very, very repetitive, right? It's just now it's gotten to a point. I mean, as a community, we've listened to him so much this year, right? We've heard him at the ECB forum, we've heard him at the FOMC press conferences, we've heard him at these other speeches, we've heard him at all these different places, and it's the same script. It's the same script. Nothing changes. Even questions, they don't they answer pretty much the same things. And Francine Lacroix, I think that's how you say it, she was the moderator at the ECB forum, and she was again hammering on that fiscal policy point. And Jerome Powell was again, said that I'm not in the business of advising for fiscal policy, which again, it's just very, very repetitive. So I think all he's trying to do right now is calm the markets down, calm people down, and see what happens in the future. I think nobody really knows where inflation is going to be. Rowan, must-watch video on semiconductors. Yes, so appreciate that very much. Wow, so PayPal, yep, down 4%, $68. We got Google down over 2.88%, 2,100. Amazon here over almost 4%, $104. We got Tesla down 1.2, 676. Meta's down 1.5, and then we got Apple down 2.4%. Apple, on a day when Apple's down 2.4%, I think that's that's quite the day. All right, everyone. So I think that's going to be it from me. Once again, thank you so much for joining. I really appreciate it. The NASDAQ down a little bit over 2%. We've got the Dow Jones down over 1.7%, and we got the S&P 500 down over 1.7% as well. So markets, unfortunately, selling off even further, which again does not come as a surprise. There's been volatility. Nothing really has changed from a macroeconomic fundamental standpoint. So always ask yourself that question. Technically, sure, we can see some rallies like we saw last week. Oversold conditions can reverse, and we can still see shorts cover. That can lead to some green days and green weeks. But don't FOMO in on those rallies, and have a good understanding on what the macro environment's telling you, and where's the overall consensus for earnings and PE multiples. So thank you so much for joining. I really appreciate it. And again, thanks so much. I appreciate it. Make sure that you drop a like, and of course subscribe if you're new to the channel. We talk a lot about fundamental analysis, technical, macros, options, everything is as much as we can cover that. We do. And of course, a link's going to be down in the description for our Discord and our Patreon if you want to get access to our Google Sheets, tutorials, private videos, alerts, trade ideas, private chats. Everything is going to be included. So links down in the description. Happy investing, and I'll see you guys in the next video.